The reason why BYD has run up so much really is because of its electric vehicle market, or the electric vehicle product targeting that market. The problem I have is that it's less than 5% of their revenues today, and most of their growth is really coming from the conventional vehicle market, while some of its other segments, which is the handset and the battery segments, are pretty weak. In my mind, there's probably plenty of time for investors to get into this electric vehicle market. There's going to be a lot of competitors. We heard over the weekend Nissan coming in. We have Geely Automobile also having its own product. So I think it's too early to tell whether BYD is going to be the only player or maybe the winner in this market. And I think a valuation as high as it is today, which is almost 35 times, is probably too expensive in my mind.
Well, let's talk about that. BYD's earnings multiple for next year is twice that of its peers. It trades at almost 4 times the book value of the sector. You see fair value, if we're correct, around 40 Hong Kong dollars, 20 times next year's earnings. Can you talk a little bit about how you arrived at that target?
Sure. I mean, the peer group, which is the ones that I mentioned, the Geely Automobiles and the Great Wall Motor and Dongfeng, they're all trading at around 15 times. And some of them also have an electric vehicle product. So there's really no reason why BYD alone should be trading at about a 35 times multiple. And you know, the battery part of it is still yet to be determined whether it can outlast other battery products in the electric vehicle market. So I think it's too early for people to get excited on the stock. I think it all started when Warren Buffett put the money in a year ago, but at that time the stock was around $8. Now it's I think it ran up almost to 70-something before pulling back. So I think you know, $40 is actually a pretty aggressive valuation, but that's probably where I'll feel comfortable with looking at the stock again.